You see, what has happened in the meantime is the Treasury General Account, that is the Fed, the Treasury, have been issuing bonds to top up their general account, which is taking cash out of the system. So they've withdrawn about 500 billion since July the 16th. That has hit risk assets somewhat. And of all the risk assets, the one that's most susceptible to liquidity is crypto. So crypto got that. The liquidity withdrawal stops about here. We're at the point where we don't need to withdraw any more liquidity, and the Treasury General Account is topped up.
Liquidity has been draining from the system, and crypto has felt the impact the most. Since mid-July, the U.S. Treasury has pulled $500 billion to refill its general account, removing cash from market. Now that this withdrawal is reaching its limit, the implications for Bitcoin and other risk assets are significant, according to RaoulPal, CEO of Real Vision. Markets move on liquidity, and Pal believes it's about to take center stage again. After months of Treasury bond issuance draining cash, risk assets like crypto have been stuck in sideways, choppy action. Ethereum and Solana have tested highs only to fade, while Bitcoin has struggled to break out. Pal argues this is just a pause. Once the Treasury's drain ends, liquidity will return, fueling the next leg higher in what he calls Phase 2 of the banana zone cycle. For investors who can ignore short-term noise, Pal sees this as a rare setup where patience could deliver outsized reward. Stick around until the end of the video as RaoulPal explains why liquidity drives nearly all of Bitcoin's price action, what Phase 2 of the banana zone really means, and how long-term investors can position themselves to capture the upside as this cycle accelerates. Cybercriminals are getting smarter, and everyday investors are the new target. You worked hard for your crypto. Don't lose it to a scam. Recently, attackers bribed offshore agents at major crypto platforms, stealing names, birth dates, even social security numbers. They drained real accounts in seconds. No blockchain hack, just human error. Once it's gone in crypto, it's gone. That's why ITrust Capital created the Premium Custody Account, the most secure way to protect your asset. It's a closed-loop system, meaning funds can only move between you and your account. Even if someone gained access, they can't steal your crypto. Backed by institutional-grade custody at no extra cost. Sleep easy knowing your investments are locked down. Click the link, use code DOSE7, and get a $100 funding bonus. Start protecting your future with ITrust Capital.
Here's total global liquidity. We're pretty much at all-time highs, as liquidity is growing at 8% a year. That is the liquidity we think of because we're crypto people or technology investors. We think of this as great. For everybody else, including for your income, this is debasement of currency, and it's totally screwing you over. Your cash savings, all of that, it's all based around this. If you're not beating this 8% annualized growth rate of global liquidity plus 3% inflation, that's 11%, your future self is getting poorer. This is the game we're in. This is why we're taking absurd, ridiculous, irresponsibly long risks in technology and crypto, is to unfuck our futures. And I'm trying to help you do that and teach you how to do it. And then all you can reply is when banana. Yes, you. I'm looking at you. Okay, why does it matter? It is what Bitcoin is. It is what NASDAQ is. It is what is driving markets. In addition, there are two different scales here. Why? Because Bitcoin is exponential based on Metcalfe's law, which is a network adoption model. So over time, you get the outperformance of the network plus the debasement, which is why it's la-la land in terms of performance. Bitcoin, Ethereum, all the big tokens. I use Bitcoin because it's easiest. It's got the longest track record to show people within. But Solana, Sui, you choose your thing. It's all based around the same thing. Why it matters, it has a 90% correlation. So 90% of the price action of Bitcoin is explained by this one macro factor, liquidity. Oh, and by the way, 96% of the NASDAQ. So what we have, and I keep trying to explain this to people, I'll explain to them tomorrow in more depth. We have a single macro variable that explains 90% of the price action of every major asset. That makes it the easiest macro risk-taking opportunity of all time because everything else is noise. Everything is just wiggles. You see the wiggles. These are wiggles. It's just noise. Wiggles. It's all noise, because this is the trend. You just need to understand liquidity, and then you understand the directionality. And if you're caring about the next 3 weeks, the next day, the next month, you are doing this wrong. Global liquidity, what's it doing? Well, global liquidity year on year is not at all-time high. So we're not at the acceleration phase. We've seen global liquidity increasing. It's just ticking down recently. Oh, guess what? The markets have ticked down a bit. Bizarrely, this was the banana zone phase one correction, start of phase two. We think it starts doing more of this now, which is the acceleration phase. It won't do this because obviously we don't have a pandemic. So we're looking for liquidity to rise to something like 10 to 15% a year, stay there for a while, and that will start really driving assets. Okay, so the global M2 chart, the famous chart that every fucker copied, and I really appreciate you guys. You guys are absolutely brilliant, because you go online and call anybody out who uses this chart without referencing Julian and I. I really do appreciate that, but this is our work. And again, nobody really understands it because they're so superficial in how they look at things. We've always said things will deviate, things will change. Here's the 12-week lead. Since July 16th, 2025, we've seen this weird underperformance. And it was like, it's broken. It's broken. See, you are morons for following this. People start forgetting about it. We don't forget. You see, what has happened in the meantime is the Treasury General Account, that is the Fed, the Treasury, have been issuing bonds to top up their general account, which is taking cash out of the system. So they've withdrawn about 500 billion since July the 16th. That has hit risk assets somewhat. And of all the risk assets, the one that's most susceptible to liquidity is crypto. So crypto got that, which has been this choppy. It went up. Alts have been outperforming. Then they came back down again. And it's been just a bit sloppy. Nothing more than that. There's been nothing really adverse going on. Just a bit sloppy. Top of the range for ETH, top of the range for Sol. Tried to break out, came back down. Fine. But generally it's because they're sloppy because liquidity has been taken out very fast. The liquidity withdrawal stops about here. We're at the point where we don't need to withdraw any more liquidity and the Treasury General Account is topped up. Okay, so that negative thing has gone probably today, tomorrow, this week, next week, whatever. It's gone. And we start to see that liquidity will play catch up. Does it catch up to this chart? I don't know, but it always has done in the past. And I'll come on to the past in a sec. Okay, then we go to the NASDAQ. It's actually done really well in recent times, following this beautifully, because 97% of NASDAQ's performance is explained by this. But look at this in the past. NASDAQ can do this shit too. This is all based on flows. So NASDAQ is getting consistent flows based on this technology bid that's going on. And it's sucking in capital from foreign investors, etc. And Bitcoin just has been sloppy because it's had less of the capital that was available. So it's the marginal capital. As the marginal capital comes back, Bitcoin outperforms. And I'll show you that. So here is the chart of Bitcoin versus NASDAQ since 2022. So Bitcoin's been outperforming NASDAQ. That's its job. That's what it does. This is why we own it. And it does these kind of nice corrective patterns up, corrective pattern up. And what we've done is we're back near this old 2 standard deviation favorite place of ours, where generally Bitcoin outperforms. Now, I've noticed many of you, and I noticed on X, are all like punting tech stocks and saying, well, crypto, it's boring. It's changed. The market's changed. They're all different now. It's not. Just shit happens. Short periods of time. So that happens. And what will happen is the more of you, I even heard from good hedge fund in crypto, they're like, yeah, we're thinking we're just going to trade more stocks now because, the crypto market's not the same. So what they're suffering from is this. And what will happen is this. It's so fucking obvious. And I use DMARC. This is on Bloomberg. I got told off for Tom DMARC for using a fake version, but I use this anyway. And I've paid for DMARC for 20-something years, 25 years. We've got the 9-13-9 pattern. So that starts to suggest Bitcoin will outperform technology. Maybe technology corrects a bit. Bitcoin does okay. And then Bitcoin starts outperforming. And I would suggest that alts will outperform. Another interesting chart for you, not related to the liquidity flow, but located to when people start getting fixated on a particular type of market. S&P in the 90s into 2001 versus S&P today has been extraordinarily similar. And that's this technology narrative, the AI narrative, and how it's taken hold there. So just an interesting chart. Whether it holds forever, I actually doubt it. I think this probably comes up, then comes down. I think this whole cycle lasts a bit longer.
Pal emphasizes that liquidity is the key macro driver, explaining 90% of Bitcoin's price action and over 95% of the Nasdaq's performance. The recent $500 billion Treasury drain accounts for crypto's recent choppy, sideways movement. Now that the Treasury's general account is replenished, he believes we're entering phase 2 of the banana zone, an acceleration phase where rising liquidity fuels Bitcoin's rebound, with altcoins likely to follow.
Why is Bitcoin sort of not wildly off to the races yet? And it's this chart. Bitcoin is basically, this is a detrended Bitcoin, and it's basically the ISM, which is the business cycle. Remember, we've always said it's the business cycle stupid. It is always the business cycle stupid. And all of these people who claim it's the 4-year cycle based around this and that, they don't understand the fundamental of what the business cycle is, why there's a 4-year cycle in everything. And we've explained it. We'll go through it in great detail tomorrow in our Everything Code presentation. But basically, it's following the ISM. And rates have been following the same pattern. You see, rates should have come lower. They need to come lower because we need to roll the debt. We've talked about this. That's part of the Everything Code, fundamental part. And ISM, because rates are so high, has meant that Main Street has been screwed while Wall Street's made money from debasement. Earnings versus scarce assets. This is the issue that they need to solve, and they need to get rates lower. They get rates lower. Why? Why do we have an elongated business cycle that looks like virtually no other real other time? It's because, and I only just found this out redoing the work on the Everything Code recently, is that in 2021-22, they actually extended the maturity of the debt from 4 years to 5 years. So that extension of the maturity of debt has pushed out the business cycle a year. The 4-year cycle this time around is a 5-year cycle. We don't know what the next one will be until we see where they all end up getting refinanced, whether it comes back to 4 because they managed to get some stuff at the long end, or whether they shorten it because everything's in the short end. We don't know yet. But this one is a 5-year cycle. And this is what it looks like. A 5.4-year sine curve. 5.4 years is the exact average weighted maturity of the debt. And it tells us the ISM should peak by 2026. We think liquidity probably peaks before that, as the rate of change of ISM changes and the rate of change of liquidity changes. Our best guess remains well into 2026, probably Q2. We'll have more information on that in due course. Part of that is driven by our financial conditions index. This leads the ISM by 9 months. It says in 9 months' time, we're in September, so this is June, the ISM will be 56.3. That's still not racy. At the tops of the cycle, it actually gets usually a bit higher than that. It usually gets to sort of 58, maybe 60. Regardless of where we get to, in 9 months' time, the ISM will be that. That's June of next year. That tells you the cycle, probabilistically speaking, will end up going up until Q2 next year. So remember that M2 chart? I see a lot of bullshit, again, as ever, on X saying, well, it doesn't work. It's never really worked in the past, blah, 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 blah. So here is what it did with the 12-week lead applied in what we think is the most similar cycle to this one, which is the 17 cycle, 16, 17 cycle. And back then, Bitcoin followed it really well. It worked really well. And in fact, Bitcoin peaked after Global M2 peaked. But you can see how well these things work. They're not perfect. Look at all of these divergences where you're losing your shit saying, well, it's doing different things. It's underperformed here. Bitcoin outperforms here. It's underperformed here. Why is it underperforming? In the end, it's all bloody noise. So that's what we're saying. The other one is when we look at a similarity of that pattern, we kind of see that 2026 is more 2017. And that somewhere contextually there's this extra year, and it feels like it's all to play for. And it's very remarkably similar pattern. Again, we're not looking for this to repeat perfectly. We're giving contextualization that if we go longer, the price is going to go higher than people expect. That's a function of that log regression channel I often show you. And I think that is the most likely outcome. And there'll be somebody on X now saying, yeah, you're going to blow everybody up. We're going to try and do our best. That's all we can do. And you guys have to manage your own risk. We're just trying to do the best we can to help you navigate this. And by our probabilistic standards, we think that it goes well into 2026. And you'll probably have, this says like towards the end of this year, you'd have some sort of correction. Well, can you imagine how many people are going to, if we got a little parabol over 200,000, how many people are going to say it's the top? I'd say 70% of FinTwit or crypto Twitter. It'll correct. And then if we're right, then it takes off again. Okay, that's unexpected. And this is what's been in my head for a while, is we're going to trap everybody who has PTSD from the last cycle, and everybody who's the 4-year crypto cycle is sacrosanct. That's my guess. I know there's going to be a ton of people arguing about this. That's my best guess. There's also a bunch of discussion about, hey, isn't this a cycle top? No, morons, no. The banana zone. We are in an elongated cycle. This box will probably be significantly longer than a previous box. We said phase 1 of the banana zone. Phase 1 correction. We're still in the early stages of phase 2. Phase 2 is going to take us up here. Maybe that's the 200,000. Maybe it's further. I don't know. We will then have a correction. We saw that in that chart previously. Look, think of this. Oh, look. Could that be phase 1 correction? Ooh, and then we go to phase 2 correction. Oh, and then phase 3 correction to the top. Oh, maybe it is. Maybe it could be. That's what we're talking about. So all the people like, when banana, it's the same fucking banana. It's going to be a bigger banana.
The takeaway from RaoulPal's analysis is...
The key takeaway from RaoulPal's analysis is clear. Crypto hasn't disappeared, it's been navigating a temporary liquidity drain. With that drain ending, liquidity is set to return, signaling the start of phase 2 of the banana zone. This is the acceleration stage of the cycle, where extended business dynamics and delayed peaks give crypto more runway to grow. Historical cycles show that Bitcoin often leads, with altcoins outperforming once it stabilizes, creating a potential setup for outsized returns over the next 12 to 18 months. Volatility may continue, and many might mistake short-term corrections for weakness, but phase 2 rewards those who focus on fundamentals. For investors, now is the time to watch liquidity, track capital flows, and prepare for the acceleration that has historically marked the strongest part of the crypto cycle. For more Daily Dose Crypto News, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.